All right, today we are jumping into a real estate market that's showing some really surprising numbers. We're going to dig into a report from Gülbahçe in Turkey's Urla district and really figure out what makes this place tick for investors. So, let's get right into the data. Right off the bat, the report hits us with this number, a gross rental yield of 6.46%. Now, in a world where a lot of property markets are lucky to get 3 or 4%, seeing a number over 6, well, that tells you immediately that something pretty special is going on here. And what does that kind of yield actually mean for your wallet? It means the property pays for itself with just the rental income in a little over 15 years. You know, for most investors, getting your money back in under 20 years is the gold standard. This market just blows past that.
Okay, so those are some impressive headlines for sure. But as any smart investor knows, the real story is always in the details, right? So let's unpack what's really going on here, the financial, the structural, and even the demographic factors that are fueling this thing.
So here's the plan. We'll start with a closer look at that investment snapshot. Then we'll break down the math behind that rental return. After that, we'll get into a really crucial concept called land share. Then we'll uncover the demographic engine driving demand, and finally, we'll wrap it all up with the key takeaways. Okay, let's dive right into this first section. We're going to look at the two core metrics that the report really builds its whole case on. Honestly, these are the fundamentals you need to understand any real estate investment.
So the report really boils it all down to two powerful connected ideas. You've got gross rental yield, that's basically the raw earning power of the property each year, and then you have the payback period, which tells you how fast you get your initial investment back. One tells you how much, the other tells you how quickly.
All right, so let's get into the nitty-gritty. How exactly does the report land on that super specific number, 6.46%? Well, it's not magic, it's all in the math, and it's actually surprisingly simple.
And here's that math laid out for us plain as day. You just take the average monthly rent, $12 per square meter. Multiply that by 12 to get your annual rent of $144. Then you divide that by the average sale price of $2,230. That's it. It's a simple formula that uncovers a really powerful result. Okay, but an apartment isn't just a number on a spreadsheet, right? It's a physical asset. And the report digs into a really important part of that asset that a lot of people overlook, your actual literal share of the land it's built on. In Turkey, they call this arsa payı, or land share. And what it is your legally defined piece of the ground the building sits on. This is so critical because let's say down the road the building gets redeveloped. Your compensation isn't based on your apartment, it's based on your share of the land. Think of it as your long-term value insurance policy.
And this is where it gets really fascinating. The report shows this delicate dance. When a developer decides they want to make a higher profit margin for themselves, well, that extra profit has to come from some way. And often, it comes from the buyer's pocket in the form of a smaller, less valuable land share. This table just lays that trade-off out perfectly. I mean, look at this. For the exact same 50 square meter apartment, if a developer is cool with a 50% profit, they give the buyer a generous 72.6 square meters of land. But if they get a little greedy and push for 60% profit, your land share shrinks down to just 65 square meters. So for you, the buyer, this is a number you absolutely have to check. It's a direct measure of the long-term value you're actually getting. So we've looked at the financial data and we've looked at the physical asset data. But the big question is, who's actually driving the demand? Who's paying the rent that makes all these numbers work? Well, the report points to one very, very powerful group.
So here it is. This is the engine behind the entire market. And it's not a small trend, it's a demographic tidal wave. A staggering 65% of the local population is between 15 and 29 years old. That is an incredibly young population, and it completely shapes the economy and social scene here.
Yeah, the report doesn't beat around the bush. It calls this youth segment the main engine for the local economy, and by extension, the rental market. What this means is you have a constant, self-renewing source of demand, year after year. And the report even shows us where they're spending their money. The number one category? Food and beverage. Now for you, the property investor, this is a fantastic sign. It means the area supports this whole ecosystem of cool cafes, restaurants, and places to hang out, which makes the neighborhood more desirable and keeps that rental demand sky high.
So let's pull all these different threads together now and summarize the report's main conclusions. What's the bottom line? What are the essential things to take away from this deep dive into the Gülbahçe market?
So, to recap, the report basically gives us a perfect checklist for an investor. You want strong income potential? Check. You've got that high rental yield. A quick return on your money? Check, with a very competitive payback period. A solid long-term asset? Check, thanks to the value of that land share. And sustained demand? A huge check, driven by that powerful youth demographic. It ticks all the boxes.
And that really brings us to the final and most important question. The report paints a crystal clear picture of a market where the financial, the structural, and the demographic fundamentals are all aligned perfectly, right now. So the real question is, with a foundation this strong, what does the future look like? What's the ceiling for a market like this? And that's something for every potential investor to really think about.